Hello again. Awesome session for you tonight. So we're a little bit late. The reason being is I just want to make sure I get everything pretty well nailed on for this session. We're going to cover this time, it's for all of the corporate finance guys out there. For me, I just thought I'd get it out there for the people who want to see it. It's a great way of looking strategically at your business and how to analyse the cost of equity in the business. Now, what we're going to cover is 1/2 of the weighted average cost of capital calculation. There will be variances within your own businesses, within your own countries, within your own markets, and I'll explain some of these as I go along. But the main point of this is so that you can see how the cost of equity can be calculated and how the first half, we're going to cover the second half in another live, how the first half cost of equity is calculated for the weighted average cost of capital. So this is going out on LinkedIn, YouTube, TikTok, X, and Facebook. So I always get back to everyone's comments, but do drop me a comment whilst I'm live. I might just not see it because I'm streaming across those 5 platforms. I am TheStrategySmith. I'm a management consultant and business coach. I'm a mergers and acquisitions expert, project management expert, and I've done quite a lot of things. So the reason why I wanted to do the WACC calculation was I have had a lot of queries as to how a discount factor can be calculated. Now, if you're in a public business, if your business is publicly traded, you'll be able to find a lot of this in open market or in market websites and financial websites. There's also ways that we can calculate certain things as long as we're provided with the data that we need to calculate it. I'll cover what's available, should be available within other businesses as well. There's 2 methods that I'm going to cover today to calculate the cost of equity. I'm going to talk a little bit about leverage and gearing that we covered in another live as to how a business is financed through debt and equity, because that's taken into account in terms of the cost of equity, the market value of equity if the business is floating, if the business is publicly traded, and how the business is financed by debt and equity, because the weighted average cost of capital takes into account the cost of debt, corporate tax, if there's corporate tax in your country, and that's why this was specificities in terms of the country is one example. Then adding the cost of debt to the cost of equity, and then being able to understand that a little bit more clearly. So we're going to look at now the cost of equity. There's 2 methods that we're going to look at. One is called the capital asset pricing model. The capital asset pricing model looks at the risk-free rate of what's available in the country. So the risk-free rate, it assumes a constant return irrespective of any form of risk premiums, things like that. That's the real risk-free rate. It's wise to include for inflation, for the risk-free rate as well, so the nominal risk-free rate, because you're taking into account that if any investor would invest into this risk-free asset, it's risk-free for all investors. So it's the same for everybody as it's a publicly traded business. And so the risk-free rate of return is taken into account for the capital asset pricing model. So we're going to draw these 2 methods. We're going to draw them on this half of the board. And then when we cover cost of debt, I'm going to put them on this half of the board. And then you'll see underneath the full WACC calculation when we get through all of this. So nerding out, I don't want to call corporate finance guys nerds. I'm actually doing some corporate finance development myself. I've done corporate finance and valuations in my mergers and acquisitions journey, and also through my MBA studies and things like that. But this is something that I find, if you're able to work out the weighted average cost of capital using these methods, you'll find out more about a business and how a business ticks than you will going into the annual report and trying to do market Google PowerPoint spreadsheets. This is how I like to think to make strategy real, because if you're able to analyze a business in this way and understand from a line of sight as to, in terms of, in this case, cost of equity, what changes you might be able to make strategically in the organization, decision maker, board level, operational level, etc., how much of an improvement you can make in terms of the risk and therefore the discount factor that will be applied when valuing your business as well. So the risk-free rate, for the capital asset pricing model is then added to the equity beta of the business. Now, I'll just draw this and then I'll explain a lot more about what the equity beta is. So the risk-free rate is added to the beta, the equity beta, So I just want to make sure we get this right and drawn properly for you. So the equity beta is the weighted average return on the market. Now, what that means is it looks at how the business is trading in comparison to the market. How often does the share price fluctuate in comparison to the market? Essentially, it looks at the volatility of the share and the level of risk in the investment. So I'll just draw this for you in terms of the equity beta. So let's say you have a market that is, for argument's sake, at 2 points or at $2, euros, pounds. And here is at -2. And then here is 0. Okay, we'll put -1 there and 1 there. So if, for example, the market, let's try and draw this in a different pen. The market, we'll draw this in a dotted line. The market may be going like this as a whole. Okay, so it's staying within 1 and -1, which means that in comparison to 0, it's not fluctuating as much for this market, for this specific market. So a market could be London Stock Exchange, it could be NASDAQ, it could be NYSE, or the other ones, the other markets that you can look at, and they will have the level of volatility in the market. Now, in terms of the beta of the share, then what you're able to see is if, for example, it's going like this. Then the beta here, in terms of its level of deviation away from 0, is going to be of a much higher average, which means that the weighted average of investment, the risk goes up, because you can't fully determine, less so than this line, you can't fully determine as much as to what that share is going to do or what that investment is going to do. And so if, for example, the market covariance is operating between 1 and -1, then you could say it's not a very volatile market. But if this beta is moving up and down, then it's a bigger risk in terms of the equity that's funding the business, because it's up and down all over the place. You can't fully determine what's happening. So this would be a volatile beta, and the greater the number, the greater the risk. Well, greater the variance, the greater the risk. Now, what you're able to also look at is the individual share ideally wants to be a steady line, or at least it following the market over time. And that's where you get your equity beta from. You can calculate equity betas. Drop a comment and we can cover that in a separate live. Usually you'll be able to find equity betas from market information as to how the business is currently trading. So that covers equity betas because it's the weighted average return on the market compared to the required return on the market. So this line here that I drew in red will make it a solid line. That is the estimated return on the market. So you're comparing an investment in the company, how the company is essentially financed, to the risk-free rate, which is the same for any investor, but taking into account the equity beta of the company and the required risk premium for the market minus the risk-free rate. So you're taking into account this number here times, okay, minus the risk-free rate. Okay. So that's the capital asset pricing model. Taking into account the risk-free rate, adding it to the equity beta of share B, if the business is called Beans on Toast, let's just say equity beta of share B, multiplying it by the estimated return on the market, which is given on any market financial website, minus the risk-free rate. What that does is it gives you a relative model to compare investments, and it allows you to see the fluctuation of the shares in the market. Now, it is a single period model, so it only takes a snapshot in time in terms of the cost of equity. So the full equation would be RF plus the beta of share B multiplied by E minus risk-free rate. Okay. So that's essentially one method of calculating the cost of equity, because this gives you one cost of equity. So you're able to look at the capital asset pricing model, so we'll call that CAPM. Okay. And now I'll just rub this calculation off, this graph off, because I want to show you the other way of calculating cost of equity. So the reason why this is taken into account for the weighted average is because you're looking at how the business is financed and the risk of investing into it. And so equity beta is the weighted average return on the market. And then you take into account multiplying that in terms of the estimated return on the market minus the risk-free rate. The risk-free rate is there because it is a premium that you're adding to an investment, which is the same for all investors. So you're able to take a snapshot in time to determine the cost of equity for the business. So now we're going to look at another method and it's called the dividend valuation model. Some mathematicians call it, well, all mathematicians call it the Gordon growth model. So we're able to determine the cost of the share price, which is divided by the dividend and multiplied by, and added to the growth of the business, growth of the dividend. So let me explain that a little bit more clearly. The dividend valuation model assumes a constant growth in dividends will be paid to the shareholders, hence cost of equity. Now, you can make this calculation much more accurate by adding in different growth cycles for different periods of time. You can also determine what growth will be by extrapolating from previous dividends that have been issued over the years. And I'll explain that calculation in a second. So what we're determining here is the cost of the business to have equity in it. So if the business is financed in the market, then if that business is fluctuating, then if you're going to invest money into it, the risk of your money going down is much higher. The risk of your money going up and down is much higher as well. So higher risk, usually higher returns, but sometimes higher losses. If the fluctuation of the beta is close to zero, then it's a much more predictable and therefore less risk of investing and therefore financing the business. The same thing happens when dividends are issued over the price of the share, and you're able to calculate the growth of the dividends issued from a previous period in time. And again, you can make this more accurate because that assumes that the dividends issued are going to grow. And therefore, the cost of equity in the business grows likewise because you're paying equity out. If a shareholder can determine that keeping the dollar, pound, or euro in the business increases its value, which it does to an investor because you hold more capital, can invest it, or you're a better risk for raising funds, then if your dividends are high or continue to grow steadily, then your cost of equity is going to increase. And then you're able to determine from previous years what that level of growth has been. And so dividend valuation is the DVM model, dividend valuation model, takes into account the dividend issued over the current price of the share added to the growth of the dividends released. So to determine the growth, like I say, you can add in more growth cycles over more periods. You can look at more complex or more accurate ways of calculating growth. You can use a number of periods and a number of different growth measures, but essentially you need to compound the growth over time to determine how much it's grown from 3, 4, 5 years ago to get a good understanding as to, so you can assume the constant growth of dividends being issued, i.e. cost of equity, is going to grow over time. So you take into account the dividend over the price added to the growth. Now the growth, you can take into account the dividend issued, so we'll determine G. If the dividend issued, let's say year 0, dividend issued at year 0, divided by the dividend issued at year -5, so 5 years ago, and then taking that to the power of 1/4, because it's the share price from 5 years ago. So that'll be -4. And then you're able to determine G. So once you've divided dividend over the price and added growth, that gives you another understanding of the cost of equity in the business. So you can use capital asset pricing model or dividend valuation model. Now, they have their pros and cons. Where this becomes strategic is you have to understand how the business is financed, and also if it's a publicly traded company, how volatile the share price is, and how predictable it is, therefore, to assume moving forward. I like sometimes to understand, in terms of growth, to forecast it moving forward. You could make it more accurate, like I keep saying, adding in longer periods, different periods, and different growth forecasts. But you can also account for inflation for growth as well, and you can assume inflation will warrant a higher dividend to match inflation moving forward. That, of course, will increase the risk and cost of equity if dividends are being issued. Now, I looked at this with other big companies that issued scrip dividends. So instead of issuing cash to its shareholders, businesses issue more shares. Now, it's great for the business because it's worked out the fact that holding money is worth more than issuing money. And issuing shares dilutes, in some regard, the shareholders' value because they're receiving more shares in the business. But as long as the share price increases from other areas, then people are continuing to invest and therefore finance the business. So issuing a scrip dividend and issuing more shares to shareholders encourages investment as well. And so as long as the share price remains less volatile, steady, and growing, therefore a scrip dividend protects the cash within the business and makes the business a better risk. And so that's where dividend valuation model can come into the forefront as to how to determine the cost of equity, because you'll need to choose one of these, and then being able to compare which ones will be able to give you a range of discount factors. So, for example, could you loan money, or could you invest in the business at the risk-free rate? Would you be happy at that? Would you want to add in more risk premiums to add to the capital asset price model? Are you happy with the equity beta? Are you happy with the way the market's looking at the moment? Does a more accurate prediction of cost of equity, is it reflected in the dividends that are being issued in the business? So a person looking at your company will want to understand the cost of equity in the business and the level of financing that's involved there. So we've determined now cost of equity. So either capital asset pricing model or dividend valuation model gives you the cost of equity. Okay. That is then multiplied by the gearing, the leverage of the business, how the business is financed. In this half of the equation, because we've looked at cost of equity, we look at equity over debt plus equity. Now, if it's a publicly traded business, you need to look into the market value. And the reason for that is because if it's got shareholders investing into it, then the market value will determine how the business is financed. So determining the market value of equity over debt plus equity will give you a good understanding as to how the business is financed. Now, if it's a private business, equity over debt plus equity will be shareholders' equity. And you're able to determine how the business is financed in comparison to its assets. Well, and if it's a public business, you determine the level of finance of equity and debt in comparison to its assets. Because on the balance sheet, assets are equal to debt plus shareholders' equity. And so the reason why we covered the four in other, look at the Ian Smith group on YouTube, we covered 4 ways to determine financial health: liquidity, profitability, asset management, and solvency. This is the solvency, leverage, and gearing part. Equity over debt plus equity. So when we look at cost of debt, we will look at debt over debt plus equity, because here we will take into account 2 ways again to determine the cost of borrowing and the cost of debt in the business. So just want to make sure we've covered cost of equity and why that's important and why it's included in the WACC calculation. WACC WACC. So dividend valuation model, it assumes a constant growth rate of dividends are going to be issued. Capital asset pricing model determines the weighted average return on the beta and also on the market. So taking into account the equity risk premium, multiplying it by the equity beta, adding it to the risk-free rate to take into account return on the market, risk-free rate for all investors, and then the specific equity beta for the volatility of that share, highlights the cost of equity for publicly traded companies. Because there's a bigger risk if the share price is more volatile, if it's in a steady market as well. And then in terms of the dividend valuation model, that assumes constant growth of dividends over time and therefore is more risk to the cost of equity. You can make growth more accurate by adding in a number of periods and different growth rates if you're able to determine them. You can include for inflation as well to give a more real return on investment. So, for example, the cost of equity would go up, but an investor wanting to invest would see that if they took into account inflation, what would they get back in dividends and things like that. And there are a couple of disadvantages with capital asset pricing model. It's a snapshot in time as to what the market is doing right now, how the business is trading right now, and also for dividend valuation model, it's only accurate if G is calculated as best that can be. So if dividends haven't been issued, for example, then you can determine cost of equity in another way. But if you're only extrapolating from previously issued dividends, then it's not necessarily a true reflection as to what's going to happen in the future. But you still need to have something to determine the cost of equity. So you can consider calculating inflation into growth, and then cost of equity, so 1/2 multiplied by equity over debt plus equity. And then on this half of the board, we're going to look at cost of debt. So just to give you a highlight, that can take into account the credit risk premium of the business, so the credit rating with the risk-free rate, or it can look at annual interest over average annual borrowing. Takes into account corporate tax and also looks at the gearing from the debt side, debt over debt plus equity. And then what you are then able to do is take into account the cost of borrowing multiplied by the debt over debt plus equity, and then adding it to cost of equity. And then you've got the weighted average cost of capital for the business. So, finance guys, give us your feedback. We can add some numbers to these as well. If you drop some comments and like and subscribe, we'll add some numbers, and we can pull out a big business, small business, your business, to determine the weighted average cost of capital if you want. We will cover cost of debt in another session, but I hope you've enjoyed a bit of WACC calculation, cost of equity. See you later. Have a good one, guys. Good one, guys.